Hey, here we go. Hello, everyone. Welcome, welcome, welcome. We're so excited today to have Harlan Accola here. And I love to give you a little tip here and there. So because Harlan talks about reverse mortgages, and most people are, well, you must be at least 62 to do a reverse mortgage, but a lot of people think of it as retirement. So I was reading this article the other day that said, when you're planning your retirement, there's some things you should plan. They have this word, trick. So you use this trick. And the first one, Harlan, you will like, is taxes. So you're going to talk about taxes today. The second one is risk tolerance. What kind of risk can you take? Your investment mix. You need to look at what you're putting your money into, mixing it up. For instance, I am a solo real estate. People think that's crazy, but I'm in so many different ones. I've really covered myself. And then C is cost to live. You've got to know what your expenses are. If you ever need a budget, I have a spreadsheet you can get. Just let me know. And then the last one is K, knowledge gaps. You know why this is important? There's no way you can know everything there is to ever know. We know just a little bit, and I think that we have lots of gaps, way too many gaps, frankly. So there is that. And our little quote for today is keep an open mind. Our job is not to make up anybody's mind, but to open minds and to make the agony of the decision-making so intense you can escape only by thinking. And my favorite's from Buckminster Fuller, if you know who he is. He created the Geodome. And belief is when someone else does the thinking. So, yay.
That's good.
Love it. I love it. So here we have our wonderful Harlan Accola. And Harlan, he's going to talk to us about taxes today and tax advantages of being in a reverse mortgage. He's been in the mortgage industry for more than 20 years and now is a national reverse mortgage director for Movement Mortgage. He's widely recognized as the authority on reverse mortgage loans and retirement finance issues. The most rewarding part of his career has been helping homeowners and home buyers age 62 and older to realize the benefits of reverse mortgages and achieve their better retirements. Harlan is deeply committed to improving how retirement is done in this country. Thank you for that. Harlan is skillful, highly sought after speaker who delivers presentations that will give you a different perspective. He often asks his clients and professional partners, if what you thought you knew about mortgages and financial planning was wrong, when would you want to hear about it from us? Now, that would be my answer. When Harlan isn't helping his clients and trusted professionals with home equity retirement strategies, he enjoys serving as a wedding officiant, traveling, and spending time with his family. Harlan and his wife, Brenda, have been married for over 30 years and reside in Minnesota. They have 4 adult sons, each now married, and 5 grandchildren. Congratulations, Harlan. Sorry, I'm just getting over a cold. My apologies. So, Harlan, it's all yours. Take it away.
Sounds great. Well, thank you. And, it's exciting. Retirement is always something that people get excited. There's so many things that we look forward to that's going to be so great. And then sometimes we get there and sometimes it's not as great as what we thought it was. And often that's because of not enough planning, because a lot of people just think, okay, I'm just waiting to get there. And then you just think it's going to be great once you get there. And for some people it is, but there's a tremendous amount of people that don't do very much planning. And because of the business that I'm in, and because of the number of financial advisors that I work with, realtors and people like Peggy that do alternative investments and life insurance agents and attorneys that do trusts and wills and so on, I've been privileged to be around a tremendous amount of researchers, authors, people that have financial planners that are in doing the actual work, that there's so many things that I've learned from all of these people that's helped my own personal retirement, even though I'm not retired, my own personal fourth quarter of life. And so it's really something that is absolutely critical to figure some of those things out. Now, the biggest mistake that I have seen in working with literally thousands of retirees is not planning for taxes and not really having a strategy. The biggest strategy that people have with taxes is to kick the can down the road. Let's just defer taxes. Let's get an IRA. Let's get a 401k. Let's not pull as much money out this year or whatever. And sometimes that makes sense to defer taxes. Sometimes it makes sense to, decrease spending or whatever. But I was talking to somebody the other day, and they were very proud that they had a $3 million retirement plan. It was all an IRA money, a 401k that was going to be rolled over to an IRA. And I said, have you ever thought about the amount that you're going to pay in taxes? And he said, well, I'm going to take it out in a lower tax bracket. And I said, you've got $3 million. How do you know you're going to be in a lower tax bracket? I'll never forget, my high school teacher came in one day when I was working with her on her own reverse mortgage. And she threw her taxes down on the conference table. And she said, I thought I was going to be in a lower tax bracket when I retired. I'm paying more now than I did when I was a student teacher. The only people that pay very little money in retirement are people that are broke. And if you're broke, that means you don't have money, and that's not good either. So taxes are a fact of life. You've heard the thing over and over that the only thing sure is death and taxes, and there's quite a bit of truth to that. So when we really went over things with this particular client, we found out between his advisor and myself and his CPA that it was going to be very, very difficult for him and his wife to get by on less than $1 million in taxes if they didn't change something. And he thought he had 3 million. He really only had 2 million. That's something I frequently ask people when they give me an IRA statement. I said, well, how much of this is yours and how much is theirs? And, they'll usually say, well, that's all mine and that's all hers. This is my statement and this is my wife's statement. That's all ours. And I said, no, but I ask you, how much is yours and how much is theirs? And they, kind of look at me funny. And I said, understand how theirs is spelled. The IRS. When you really think about it, how much is yours and how much is theirs, the IRS, that means that we have a requirement that a certain amount is going. And as that grows and the 3 million turns into 4 million, if they don't start taking it away right away, then you're going to be taxed on 4 million or 5 million. Your tax bill keeps going up, doesn't go down. And then what if the tax laws change and you end up paying more because the rate's now 28% instead of 26% in your bracket, whatever the case may be? So one of the, I don't pretend to be able to, in the next 45 minutes that we have left here, to be able to solve all of the tax problems. But we know that real estate in itself, any of you that are in real estate know that there's some inherent tax breaks inside of real estate. So certainly I'm not going to go into all of those because you're familiar with some of those things, 1031 exchanges and DSTs. And, there's a number of things that I've been personally involved with and worked with others on. And Peggy can tell you about a whole lot more than I can. I'm not going to cover those things during this discussion. But what I am going to cover is specifically what I'm good at and what I'm knowledgeable on in working with tax, I specifically, all of the things I'm talking about, I've discussed with tax attorneys and some of the top tax attorneys in the country, CPAs and so on. So what I'm sharing with you, I'm not a CPA, but what I'm sharing with you is some things that without question, reverse mortgages are very instrumental in. So before I jump right into the reverse mortgage, I'm going to jump back to the 3 buckets here for a second. Now, here's anybody that's heard me talk before, you've seen this, so I'm not going to spend a lot of time on this, but just for basic information so that we go back to this is everybody who owns a home has three buckets of wealth. Bucket one is your income, your ability to make money, wages, commissions, Social Security, pensions, whatever. Bucket two is money, your nest egg, the money that you're set aside. And we call it the nest egg, right after nest egg builder. That's interesting. But we always refer to this as the nest egg, the money that you don't need today, but you put away for the future. IRAs, life insurance, of course, real estate, savings, 403Bs, whatever. All money that's put away for the future. And then you've got home equity. And the problem is that most people don't believe that money should not be taken out of bucket three until you're broke. I just had a financial advisor call me today, and he didn't know anything about what we did. He was referred by one of our loan officers, and he said, I think I've got somebody that needs a reverse mortgage. I've never had somebody that needed a reverse mortgage before. He's got 300 clients. And I said, this is not about needing one, it's about wanting one. And he said, well, I've got this lady that's 90, and she's in care, and her husband is trying to take care of the memory care that's $10,000 a month. So in just a few months, they're going to run out of money, and then they're going to need a reverse mortgage. By far, that is the thing that most people think of. When you're broke, when you have no other options, then you take money out of bucket three. Up until then, you take money out of bucket one, you draw Social Security, you go back to work at Home Depot or McDonald's or whatever. Bucket two, is money that you pull out, and in this case, they're going to drain bucket two within a few months. Now, maybe it makes sense to pull money out of their $700,000 house. So here they got almost $750,000 sitting in their house, and they haven't used any of it, and they're 90 and 92. Really crazy when you think about it. It's strange. And yet that's the way most people think. I'm not going to go into a lot of details of the psychology behind it. If you want a copy of my book, I'll make sure I get you a copy of that. Ask Peggy for it and she'll give me the details. But anyhow, here's the scenario. A reverse mortgage should be almost always used, just like you always draw Social Security somewhere between 62 and 70, and you always take Medicare at 65. A reverse mortgage should be used most of the time, not once in a while. I took mine as soon as I could at 62. I turned 62 on April 26th a few years ago, and on April 27th, I'm signing my reverse mortgage, not because I have to, not because I need it, but because I want to have more money available in bucket two. I'm like Peggy and her team. I like to invest in real estate, and I like to put money aside for the future when I'm still working. And I don't want to put any money more than I have to in bucket three, because the money in bucket three is illiquid. And that money is also money that is very locked up and uncertain as to exactly what I'm going to be able to get out of there. So all a reverse mortgage does is create liquidity for part of the investment. That is the bottom line situation. So there's three types of clients that can use reverse mortgage: people that have the house paid off, people that are still making a mortgage payment, and people that are in the wrong house that would need to move and buy a house. So that's everybody. And here's the interesting thing. About 56% of senior homeowners that have their house paid off could use this to mitigate sequence of returns risk, long-term care funding. And here's the first tax savings: income to avoid to move up to a higher tax bracket. All the money coming out of the house is tax-free. And so when you're using that, it is a dramatic difference as compared, just like pulling money out of a Roth IRA. It's something that you don't have to pay tax on. And then the second one is Roth conversion tax payments. Roth conversions are huge, especially now, because tax cuts are going to expire unless things change. Obviously, they're talking about things like that. Group two is people that are still making a mortgage payment. That's about 44% of the people that are out there. And many of them have mandatory payments going into their 80s or 90s. Where could that money go? Imagine investing that in some passive real estate. Imagine putting that into something that's going to pay you money and increase by 10, 12, 14, 18, 20, 25% instead of putting money just in the house. Will the house go up? Sure, but the house will go up in value whether you have a mortgage or not. And then group three are just people that downsize, upsize without tapping into the portfolio. So here's the three main ways that you can save on income taxes when it comes to reverse mortgages. Now, the first one is Roth conversions. I've worked with Ed Slott on this. Many of you know him from the PBS show. He's the IRA guru. I personally worked with Ed. Brilliant guy, funny guy, typical New Yorker, very to the point. Got a lot of Ed Slottisms, as we call them, just crazy things that he talks about. But anyhow, he is really big on Roth conversions because he feels that taxes are going to go up. And quite frankly, I found out that most people believe taxes are going to go up. I mean, we know that there's huge deficits. We know that the interest on the national debt is going up. The chance of income taxes going down is highly unlikely. People say, well, if Trump gets in, he's going to cut taxes. Well, maybe not. But the bottom line is, in a longer period of time, taxes are going to go up somehow, some way. They have to. Anybody that tells you that taxes are not going up when there's more spending, it's like having a deficit spending in your checkbook. Either you have to earn more money, and the way the government earns more money is to tax, or you have to go broke. And the government's not planning on going broke, so they're just going to have to earn more money, and they're going to take it from you and I or anybody that has money. So the earlier, in my opinion, and the opinion of many, many advisors, the earlier you do Roth conversions, the better off you'll be. But the problem is, where do you get the taxes? How do you pay the taxes? You got $1 million IRA, you convert it over. Well, now you've got a $750,000 IRA or a $700,000 IRA. If you live in California, you got a $500,000 IRA. All of a sudden, half of it's gone, or 20% or 30% or whatever the case may be. So a lot of people don't want to do Roth conversions, so they kick the can down the road and wait. We'll show you that in a minute of just one example. Stacking deductions. This is something that I personally use. My deductions are continuing to go up. I just checked today. I got my statement in the mail that says this is not a bill. It's cool. I owe $556,000 on my reverse mortgage, and it's not a bill. It's really awesome. I mean, I've had bills all my life, and my bill is zero. I really like that. But anyhow, by the end of the year, I noticed it's at $77,000. By the end of the year, I'll owe about $95,000 against my equity. My equity has went up more than what my reverse mortgage has, but it usually happens. Isn't guaranteed, but that's usually happens. So I'm going to have somewhere around $95,000 in interest at the end of this year. I can pull money from somewhere else that is taxable and pay that into my reverse mortgage, and I will get a tax deduction. We'll cover those details. The third one is kind of simple, and that applies to Medicare IRMA. It applies to any of the tax bracket creep. Whenever you need money and you want money, but you don't want to pay taxes on it, you can pull from your house, which will decrease your overall taxable income. So let's say that I need $150,000 to live, and I've only got $100,000 coming in from other sources. I can pull the other 50 from my reverse mortgage, and I only pay taxes on 100,000 or whatever bracket I want to go up to or stay below. And you just simply draw on the credit line, and you never have to pay it back. Does that cost you money? It costs you interest, but the interest is taken out of the future equity of your home. You're paying for it with kind of fake money. I mean, what it really comes down to is this. If you can see the little picture on the screen, this is equity. It looks like a dollar bill, or $100 bill, but it's not. It's just a little squeezy, thing with our QR code advertising on the back. So this is equity. It looks like a $100 bill. It represents a $100 bill, but it's worthless until it's converted into actual cash. This, of course, is cash. Cash is something that I can walk into any grocery store, any gas station, any Target, wherever I go that takes money. I can walk in and say, here, I want to buy something with this $100. If I walk in with this, it's worthless. So all of the equity in your house is worthless until you can use it. And when you pull it out, you don't have to pull it out and only get 60 or 70%. You get it all, because there are no income taxes on that. So now let's go a little bit deeper into each of these scenarios, and I'll make sure that we've got some time for questions, and you can as well type things into the chat box as we go through things as well. Interesting. Ted already saw 2 or 3 of those he's lived more than I have, but I've been on lots of Zoom calls and haven't seen that. Okay, so I'll keep an eye on that as you get a question. I I like that the difference between a tax preference and a loophole is a tax preference is a deduction or a credit, and a loophole is one of those tax preferences that you get and I don't. By the way, these are really not loopholes. These are just different ways of figuring out how to pay taxes, when to pay taxes, and getting deductions. Real estate is wonderful for getting deductions. You get depreciation and all of the exchanges and so on. So there's a ton of ways that you can save money in real estate. We're not competing against real estate investments. We're just adding some other things. You can use self-directed IRAs, and this will help you save money in when you pull money out of your self-directed IRA that you own real estate in. So a lot of different scenarios from there. So here's a very oversimplified example of a Roth conversion just to show you the math. So if there's a client at 62 that's got $1 million IRA, whatever's inside the IRA, could be real estate, could be stocks, bonds, whatever, but they got $1 million IRA and they've got a $700,000 free and clear home because they paid off their home and they are just happy that they got their home paid off and they never want a mortgage. But if you want to do a Roth conversion or think about that IRA, should you pay tax on the seed? Now, I'm a farm kid from Wisconsin. I grew up on a dairy farm and we planted corn and we planted oats. And so this really resonates with me that if you could pay tax on the seed, that's a lot smaller in the spring than the harvest in the fall, because you plant the seeds. There's just a 50-pound bag of seeds. And then in the fall, there's this whole field of corn. So what do you want to pay tax on? Well, obviously the seed, because it's a lot less than the harvest. Yet a lot of people keep pushing it off and say, oh, I'll just pay tax in the future. Well, that's the harvest then. So, and should you pay, if you are going to pay tax early, should you pay it with a reverse mortgage, even if there's negative amortization and you're going to lose some equity? Well, let's just make some assumptions for easy figuring. Let's pay tax on the harvest. Let's just kick the can down the road and say, hey, I don't care. I'll just wait. I don't need the money. It'll just grow and that's fine. So let's say there's a 10% compound growth. If you're in real estate, you're probably going to get more than 10%. If you're in bonds, you're going to get less than 10%. But let's just say you're going to get 10% because I'm going to keep them all the same. 10% compound growth, 14 years to 76 years old. You start with $1 million in your IRA, you let it grow. The account's now worth $4 million, doubled a couple of times. The tax rate in the future is assumed to be 40%. People say, well, it's not going to be that much. Well, whatever. We're just going to keep the number the same. Maybe it'll be more than that. Some people are already paying 50% in some states with state and local, state and federal taxes. So taxes to be paid at that point, if they're pulled out or if you die or whatever the case is, taxes are 1.6 million. So your final balance is 2.4 million. You say, well, that's pretty good. I started with $1 million, ended with 2.4. What's wrong with that? Well, that's okay. But what if you do a Roth conversion? Well, you're going to pay that. Where are you going to get the tax? You're going to get the tax. You're going to pay the tax in the seed, but you're going to get it from the seed. So you're not putting in a 40-pound, 50-pound bag of seed anymore. You're only putting in a 38-pound bag of seed or whatever the case may be. So your harvest is going to be smaller. The $1 million IRA is taxed at 30%. $700,000 remains. Now that $700,000 continues to grow for 14 years at 10%, you're going to end up with $2.8 million. Still, really good. It's better than the 2.4 because you paid tax on the seed instead of the final harvest number. But let's look at the optimal way to do that with a reverse mortgage. You move $1 million to your Roth from your traditional IRA. Taxes are $300,000, the same 30% number we'll use. And you put it into a reverse mortgage that's going to grow at 6%. Which the 10-year CMT constant maturity treasury index is forecasting less than that. But let's just say the reverse is going to charge you 6% over the next 10, 15, 14 years. So the value in 14 years at 10% is going to be $4 million because you kept the whole million in there. So now that's grown 4 times, doubled twice to $4 million. Zero tax on that $4 million. And the kids can pull the money out 5 years after you die, and there's no tax for legacy at all. You've passed on a full $4 million. Okay, so there's zero tax liability. So this is the best way to pass money on to the kids. And you say, well, what if I spend the money? Okay, well, if you spend the money, you still got more to spend. So we're just comparing everything the same of where you're going to end up at the same age of 76 years old. The HECM went from 300,000 to 693,000 in 14 years. So now you don't owe 300,000 because you pulled that money out, and we're a bank, we're a mortgage bank. We're not going to give that money to you for free. So we want a big check in 14 years. That 300 turned into 693,000. So now you've got to pay us back the original $300,000 in taxes plus the increase in the amount of money that you owe us, which is almost $700,000. Well, 4 million, let's subtract the 900,000 that you're paying out of the HECM, out of the reverse mortgage, and the final balance is 3.3 million. Remember, if you pay tax on the seed, let's go back up here, pay tax on the seed or on the harvest, which most people do and kick that can down the road, you're going to end up with 2.4 million. Pay tax on the seed, do a Roth conversion, you're better off 2.8 million. But if you pay tax on the seed with a reverse mortgage after you're subtracting the equity that you gave up in your house, you are still at a point of 3.3 million. So the math is simple. There isn't any question that you should do it. Some people say, well, there's other tax shelters and you could pay with life insurance policy, pull the cash value out. Yeah, there's a lot of different scenarios that you can do, but this is just comparing all three of those things together. And most people have money in their house, equity in their house, especially the last 3-4 years, to be able to get there. A huge advantage, a big deal. So, we paid the tax. Yes, Mary, we paid the tax on the beginning with and let me go back there. So if we were going to pay tax on the seed, we had to pay $300,000, but on option 3, we paid the taxes, and something happened. The taxes of $300,000 right there came from the reverse mortgage, came from the HECM growing at 6%. There's a couple of words missing there. I'm not sure how that happened. But anyhow, yes, that's where we took the money when April 15th rolled around the next year. You didn't pay it from your brokerage account. You didn't pay it from your checking account. You didn't sell stocks to pay for it. You just simply gave us a call and say, I need $300,000 to pay my taxes, and we sent the money to you. And then that grew to $693,000 in 14 years. You could have paid it off early if you wanted, but it doesn't make any sense to do that because you're making more money on other things in other areas, invested in real estate, invested in wherever your portfolio is, whatever the situation is from there. The number of people that are not doing Roth conversions right now, and I want to just really get real clear on this. The number of people that are not doing Roth conversions are going to be very, very, very sad, I predict, 8, 10, 20 years into the future. It's foolish not to get out of that. And let me just ask you this. What if I told any of you, I said, hey, Jason, hey, Eugene, hey, Lisa, I will pay your taxes for you right now. I'm a nice guy. I'm an investor, and I'll pay your taxes for you on any kind of retirement account that you have. And you say, wow, that's nice of you. What's the catch? Well, I'm going to want you to pay me back in the future. And you say, oh, well, that sounds good. I'll take your money. But just a second, Harlan, how much am I going to have to pay you back in the future? Well, I'm not sure. I'll let you know when I get there. Depends on how much money I need. How many of you are going to take me up on that deal? I said, well, Harlan, I got to know. I mean, you can't just say at some point in the future. Well, trust me. I'm a nice guy. I'm not going to rip you off. Look me up on LinkedIn, look my online profile. I'm a nice guy. I've never ripped anybody off. I've never got fined by the government for ripping people off. I'll take good care of you. And you say, well, yeah, but I mean, I need to know how much I got to pay you back, or I'm not going to take you up on this deal. You're going to ask me a ton of questions. But people do this, walk into this deal with the government all the time, and they don't have any guarantee of how much they're going to pay back in the future. All they know is that there's a kind of a crooked bunch of people in Washington, and they know how much money you have in there, and whether they're crooked or not, they're going to have a huge need. And so the question is, whoa, just a minute here. This is something that maybe I should do right now. I implore you to look into a Roth conversion this year and next year while we know what the taxes are going to be. It is foolish not to do that. I can't make it stronger than that. So let me answer a couple of questions. Doug said, what's the difference between this and a HELOC? And Peggy already answered this. You don't have to make payments. If you make payments into a HELOC, then you're in a situation that you're not going to be in a good position from a cash flow perspective. Now you got to pull money out of your investments. You got to pull money out of your job, out of your regular work to be able to pay that. There's no sense in paying that, because if you can defer payments, the beauty of not making a payment 14 years down the road, or 10 years down the road, 20 years down the road, is I'm going to pay it back with cheaper inflated dollars. And I can go until I'm 150 and I don't have to pay it back. So I don't care when I've got this bill that says this is not a bill. So you could do a HELOC, but that's the first problem, is you got to make payments. The second problem is, how do you know when it's going to get taken away? HELOCs are canceled all the time in rough economic times. Everybody I know that lived through 2008 that had a HELOC got it canceled. And so you don't even know if you're going to have it, and all of a sudden you got to pay it all back, or it gets called or frozen or whatever the situation is. That's a huge issue. The interest rate is market interest rates. It's controlled by FHA. So we're about 250 basis, to be technical, we're about 250 basis points over the CMT, the 10-year CMT, Constant Maturity Treasury Index bonds. So right now that's about 7.5%. So we're about the same as the 30-year fixed. So if you know what the 30-year fixed rate is, which is very well publicized, that's about where we're at. Do you want it fixed or do you want it adjustable? I prefer having it adjustable because I don't care what the number is. I just get a bigger tax deduction if I wait, but you can choose whichever scenario you want. Because remember, how are you paying it back? You're paying it back with equity. You're paying it back with this worthless equity. And you say, well, it's not worthless because I've got a lot of equity. Well, you still don't know what the value is. You don't know what the value of your house is next year, say nothing about 10, 20, 30, 40 years into the future. So it's very significant in that situation that you say, hey, if I can pay it back with future equity, and if my equity goes down, FHA will pay it back. Well, that's a pretty darn good deal because you're not paying it back with cash. That's a big difference. When you have to pay it back with cash, you have to figure cash flow. You have to, the interest rate is a much bigger deal. Personally, I don't care if my interest rate goes to 15%. I kind of, wouldn't be upset at all because you know what happens then? I get to have a bigger tax deduction. So I don't really care if that continues to go up, because my goal is not to die with the most equity in my house. My goal is to have be able to spend as much money as I want in retirement and have the legacy go to my kids. And I can have the legacy go to my kids with real estate with a step up in basis, which is a wonderful way to pass on inheritances. I can give it in life insurance. I can give it to them in a Roth IRA. I'm not concerned about leaving that behind. Peggy, go ahead.
Eugene's got a question.
Go ahead, Eugene.
1 minute. Hold on. I disabled people's ability to unmute. Let me just turn that back on. Okay. Eugene, you should be able to unmute.
Thank you. So I just wanted to let you know that I sent you a LinkedIn message. I'd like to set up 2 different follow-ups with you. One, my wife's setting up a senior consultancy business to go along with the residential assisted living that we're interested in investing in. I didn't put two. I was at the last meeting that you were at, and I actually didn't put 2 and 2 together until this meeting. That there's some synergy. The other, and actually I put 2 plus 2 plus 2 together because I didn't realize you were with Movement Mortgage. And we just made Movement Mortgage our primary in-house lender for our brokerage.
Wow, that's good to hear. Cool.
Yeah. So what I'd like to do is set up a follow-up with the managing broker. There's 700 brokers, so I think there's an opportunity not just for the brokers, but the reverse mortgage working with seniors. I just want to let you know when you see the LinkedIn message, it's from me.
That sounds great. Thank you for that, Eugene. Be happy to do that. And by the way, if anybody wants to contact me directly, you can find me on LinkedIn, or there's my contact info as well. The QR code takes you to our landing page with that information. We are anxious to help anybody on this call because there's $13 trillion sitting in seniors equity, people my age. and older. That's a lot of money, trillions of dollars, more money than there is in IRAs. If there's any way that we can help you by freeing up some of this cash in whatever business you have, whether it's a long-term care business, whether it is a real estate business, whether it is any kind of other a business that needs cash, let us help you. That is critical as far as in any relationship that I have. I want to figure out how I can make you money and make your business better.
We have
Because
several questions.
I'll get to that right away, you bet. Because if I can make your business better, you'll want to do business with me. But I first need to be concerned about you before I ask you for any business. So thank you for that, Eugene. Let's see.
Jonna?
Go ahead.
So my question is, what do you need to do to stay eligible or to make sure you're eligible for a reverse mortgage of this type?
We always talk about 62 because the best reverse mortgages are available for people over 62. We also have some available at 55 that are still good reverse mortgages. They're not bad. They're just not as good as the one that you get at 62. So the first thing you need to do is be old enough. So you just got to be born prior to 1962. But the other thing is you need to live in the house. So this right now is not for a bunch of investment properties. You can use reverse mortgages to buy investment properties, but you have to use your home as your primary residence, and you have to live in that primary home. In the future, will there be reverse mortgages for investment properties, for commercial properties, for Airbnbs? Yes, they're not there yet. So start with your personal home, and you have to live in it, and you have to take care of it. You have to live in your house and take care of it, because it's a situation where, which is no different than a forward mortgage. If you have a forward mortgage, you have to preserve and maintain the house. We're not going to fix your roof because we don't own the house. So great question. Thank you for that, Jonna.
Yeah, and you can't live in a senior living, Eugene, and get a reverse mortgage. You have to live in the property. Once you leave the property, then the mortgage is due. So when you're talking about setting up senior living and you want to help folks, you might have to put daycare into their home to take care of them so that they can keep getting that reverse mortgage.
Yes, the one that I had earlier today, the client had his wife was in assisted living. He was healthy, but his wife was in assisted living, and that's fine. He's taking money out of the house to keep her in assisted living, so you can do it then. But if both people go to assisted living, the loans do, because we don't want empty houses. Empty houses are not good collateral.
And the disadvantage that they have is that they need the money now. Whereas if they had pulled it out 20 some years ago, well, they didn't have a good one 20 some years ago, but if they had pulled it out in, let's say, the last 5 years, they would have had that advantage of making 20% on their money and being able to use that money to pay for, using the interest to pay for the housing rather than using the principal. Once you use your principal, it's gone. People just don't get that. They're like, oh, I got to put my kids through college. No, you got to invest and let the investment money put your kids through college.
That is so true. People need to understand that more and more. And really, we learned this in grade school. Did anybody read the story about the goose that laid the golden eggs? And they killed the goose, and then there were no more golden eggs. If you kill your investment money, you're not going to get any golden eggs. And people will literally pull money out of investments to pay off their house and leave the money sit in their house, and then all they got is their house. It's silly. And it's not only silly, it's dangerous. I talked to a lady in Long Island a few months ago, $5 million house, and she's broke. All of her money, she's in her 80s, all of her money is gone, and she's got this $5 million house. So she's a multimillionaire, but she's got it paid off, and she wants to leave it paid off because her husband said, whatever you do, don't ever get a mortgage on this house, and you'll be able to live here until you die. She can't even fix the roof. She can't go out to Panera Bread with her girlfriends. she's in a really difficult situation. Unfortunately, a financial advisor was able to get with her, get her with us so that we could help her with that. Douglas, your question: if your equity is $1 million and the accrued interest is 500,000, you leave behind 500,000 in equity. Yes. So if I died today, my house is worth about 1.4 million. I owe 556,000. So if I died today, or I wanted to sell this house and move today, I'd sell the house for 1.4 after realtor's expenses or whatever, pay off the 556 and walk away with 900,000 or whatever's left. So you just pay off what you owed, just like you would with a forward mortgage, and walk away with whatever the difference is. So great. You laid it out very well, Douglas.
There's
Mary,
one other subject was brought up, and I remember that we had to talk about that before we did mine, and that was if I wanted to pull money out to use as an investment, I was in an adjustable, but if I wanted to do it a different way, it would be fixed. Sorry, I can't remember what that was because I did the adjustable.
Yes, and I've done the adjustable too. 99.5% of our loans are adjustable because the adjustable allows you, as you'll see in my next example on the stacking deduction, the adjustable allows you to pay money in and pull it back out, pay money in and pull it back out. If you have a fixed rate, you have a fixed amount. So if you pull out $300,000 and you pay back, first of all, you got to pull out the whole $300,000 on day one. You might not need $300,000 in day one. But even if you do, if you want to pay interest back in, you can't do that with a fixed rate and get the money back out. You can take the $300,000 and pay it down to $200,000, but then you can't get the $100,000 back out. It's locked up. You put it in a lockbox. With an adjustable rate, you can put the money in, pull it back out, put the money in, pull it back out. You have way more flexibility. Before I go on to the next one, I'll answer Mary's question. Mary, here's the when I converted the Roth, I did not put the reverse mortgage money in to pay. I only used the money to pay the taxes. I didn't put the $1 million into the reverse. The house was already paid off. I owned the house. And I just had the $1 million. The house was worth 700,000 or whatever the example was. Let me pull that back up here. Where did it go? I thought I had it. Oh, there it is over there. So when you, there it is.
And David's got a question too.
Okay.
Yeah, last time.
Right here on option 3, I moved the $1 million to the tradition, from the traditional to the Roth, paid the taxes from the HECM, which is growing at 6% interest, assuming that over the time period. It's a little higher than that now, but that's the projected number over that time period. And then my IRA, whatever I had it invested in, could have been stocks, could have been real estate, could have been bonds, whatever. But I use that as a 10% example. So it's something more than bonds. And then that's what went up. And then my reverse mortgage grew from 300,000 to 693. I owed nothing on the house when I did it. This is an example of when the house is paid off. And so hopefully that answers your question, Mary. David, if the owner has a reverse mortgage, but she wants to move to care, but likes the idea as an investor to help pay the mortgage, rent, the home, and her share for care, is this okay? That would, if she moves out, if she's not living in the house, that ends the reverse mortgage. So yes, some of those people may want to have you buy the house from them, or give her a mortgage and then rent the home and take care of her care. That is not a bad idea, because she may want to keep the house and pass it on to her kids with a step-up in basis. If she sells the house, then she loses the step-up in basis, because you can only get the step-up in basis after you're dead. So would it make sense for you as the investor to pay it off for her, pay off us, because we got to be paid off in a year? Does that make sense? Probably. And as those issues come up, we'll get those over to Peggy, of people that do need to move to care. Most of the people that do a reverse want to stay at home and use the money to pay for home care or whatever. But if somebody has to move to a facility, it may make sense for you to pay off, as an investor, to pay off the reverse mortgage. I have not heard specifically of someone doing that, but that's a good idea, quite frankly, David. Like that.
If he were 62, could it transfer into his name?
Well, yes, but then he'd be buying it. And so that would end the step up in basis, because now he would have to own it.
Yeah.
And then she would lose the step up if that was her concern.
But if that wasn't her concern.
Yeah, if it's not her concern, yeah, you take it over and now you get, we've refinanced, somebody's 90 and they move out, their kids are 60 and the kids take over the reverse mortgage, and you transfer it from the mom to the son, or the, mom to the daughter, whatever.
So the transfer to David from Mrs. Jones?
It would be technically a refinance.
Okay.
It's not, in answer to your question, David, it's not assumable. It is, would have to be a refinance. It'd be kind of operate like that, but it'd have to be a refinance. And again, you'd have to live there. So important to remember the two rules. You have to live there as a primary, and you have to pay the taxes and insurance, because you don't own the house. Or you own the house. It's not a situation where you don't own the house. If you're if you're selling the house, of course, you're not in charge of it anymore, and you don't have to pay the taxes. Okay.
Yeah, I don't know that'll work for an investor right now.
Yeah. So
Eugene and John each have questions.
Go ahead, Eugene.
I'm sorry, I didn't put down my hand. I don't have any.
Oh, okay. Jonna, go ahead. You are muted.
You just hit on a point that, I'm like Eugene, the light bulbs are starting to go off. So let's say your parents take out a reverse mortgage. They're going to transition, and you think the house is a good investment for you. So you refinance it. But if you're over 62, you can then go into your own reverse mortgage if there's still equity, correct?
Absolutely. So most kids don't move into their parents' houses, but if you do, this is a perfect way to do it when you turn that age yourself, because now you just do your own reverse mortgage, and now you don't have any payments until you're 90 or whenever you pass away. So excellent point, Jonna. Thank you for that.
Thank you.
There's always one kid that never quite makes it on their own.
Does not get out of the nest. Okay, I want to
Yeah.
make sure I've got some more time for questions, so I'll go through this next one. Pretty simple, the last one that we mentioned, and that is a scenario where stacking deductions. This is what I use. Now, what we talked about specifically on the Roth conversions, that's usually with houses paid off. But when houses are not paid off, that's a little bit of a different situation, because now you can use that for stacking deductions. So separate this, forget about the Roth for a minute. That's a separate issue. So this is just taking a tax deduction off from ordinary income, off from capital gains on real estate, any other income that's coming in. Now you can see in my own personal, this is my own personal AM schedule. It shows this continuing to go up. I'm at about 500 and some now. And when I get close to 80, I'm going to be at $1 million owed. Started out at 400, I got $1 million. So between now and 80 years old, I'm going to have $600,000 worth of acquisition debt, because I refinanced the mortgage that I used to acquire the house into a reverse mortgage. So it doesn't matter how many times it goes through. I never paid the house off. This is acquisition debt. So it has to be acquisition debt, that money that was used to buy, build, or significantly remodel the house. Got a client right now in Washington State, and she's going to do a major remodel, $250,000. That interest is deductible. Interest that is taken out to have fun, give away to your kids, whatever, that's a whole different deal. That's not the same thing, because the money on home equity debt is not deductible. That changed in the 2017 tax law. But Acquisition debt is still deductible. So you can see as this continues to go up, as I'm into my 80s, 90s, I'll have 2 million. If I make it to 94, I'll have a couple $1 million worth of deductions. But let's just look, and in this first time period, that means I can make $600,000 worth of income on an IRA, on a selling a investment property. I will have this as a deduction. And you say, well, yeah, but nobody can really deduct money anymore because you got that big old standard deduction. Yes, that is correct. But the standard deduction for myself and my wife is about 30 grand. So I'm not going to pay it until I got $100,000 worth of deductions. Why do it? Why do it before that? Because I'm not going to get any benefit if I only pay 10 grand. I got $10,000 of state and local taxes and $10,000 worth of charity money. I'm only 30,000. I might as well just take my standard deduction. And I have to do that if I've got a regular mortgage. I got to pay every month. But on a reverse mortgage, you pay whenever you want. So I'm going to pay every 2, 3, 4 years, whatever. And when I've got 50, 60, 70, $80,000, I'm going to pull money out of a taxable source, whether it's a bonus, whether it's selling a piece of real estate, whether it is in any situation, making money, pulling it out of an IRA. I'm going to pull that money out, pay it into my reverse mortgage, which will reduce my balance and give me a 1098. So you can see the three-step process here. I receive some sort of 1099 taxable income. I pay it into my reverse mortgage. It's not due. I don't have to pay it, but I want to. And so I receive a 1098, which wipes out my income from page 1. When I put the 1098 on page 2, it wipes out my income. I receive full credit, however, in my line of credit. So right now I don't have any money in my line of credit. My line of credit is empty. But as soon as I pay 100 grand into my line of credit, $100,000 is available. And I can pull it out. Think about this. I can pull it back out tax-free. So we'll successfully wipe out, wash away. Some people say launder. That's not a good word to use, but I'm going to completely wipe out $600,000 worth of income tax-free, not deferred, if I make it to 79 years old. Guaranteed as long as the tax laws stay the same, and I'll still have access to all of that money. That's just another example of utilizing one of the biggest ways to utilize this that makes no sense to keep a regular mortgage. Some people say, well, I'll just keep paying on my regular mortgage. Great. You get no tax benefit. You're required to make that payment. You won't have any statement like I get that says this is not a bill and you can pay it whenever you want. It's dramatically different. And so when you take a look, and I challenge anyone to say, yeah, I don't think I need one. Yeah, well, it's not about need. That's like saying, well, I don't need a car. I don't need a cell phone either, because I discovered this thing right over here. Look at this. This is a rotary dial telephone. You don't need a cell phone. You can get these on eBay that still work for 20, 30 bucks. So it's not a question of need. It's, well, how far am I going to go trying to plug in that rotary dial phone when I've got my little iPhone here? It's more expensive, yes, to have an iPhone, but it's what it accomplishes. So do I need an iPhone? Technically not. There's some people, my wife's parents, they are in their late 80s, and I think they got a flip phone. They don't have an iPhone. They don't need one. They still have their old, they still got their, well, it's a push button, but they still have their old phone. So it's not a question of need. Think about, how can this make your retirement better? How can this make your life better? And how can I pay less in taxes?
Good.
Okay, I'll take deep breath questions.
We're at the top of the hour. So I have a real quick question, and it had to do with you borrowing money to do your fix up on your property. And you said that was deductible.
That's acquisition debt. That is correct. Not the amount that you put into the property, unless it's an investment property, but if it's on your primary residence, now whatever money you use to fix up your property, all of that interest is acquisition interest, and that is deductible.
Okay, so I already own my house, and I just want to do $100,000 to fix up the kitchen and the bathroom, let's say. So I
Yes.
can, out of my reverse mortgage, I could take that 100,000 and I could deduct all the interest on that 100,000
From
on
now
my
until
taxes this year.
the end of, you want to wait for it to build up, but from now until the end of the time that you live in the house.
Really?
And that is, it's not once in a while, it's for as long as you want. Because remember, in a reverse mortgage, you're not making payments. So you're never paying it off.
Right,
never
I
have to
got
pay it
that,
off.
but I thought I could only deduct it when I made the payment back, but you're saying I could deduct it even though I'm not making the payment back.
No, I'm sorry. And let me clarify that. You have to make the payment, but you can pull the money back out whenever you want. So if you make,
In order to get that tax deduction on that
yes,
acquisition, I have to pay it back.
because the IRS specifically says that you cannot deduct interest that is accrued. You can only deduct interest that is paid. So you pay it,
Okay,
but you can pull it back out.
all right. I
Great
understand.
question to clarify that.
Okay, now we have 1 minute left. Does anyone have one more question before we go?
Thanks for the advice, David. I'll get an adapter for my land phone so I can connect that to my iPhone.
Okay. Well, I thank you very much for being here. I have no idea how to stop this.
Thanks, all of you. If you have any questions, you've